Welcome everyone. Today we're going to tackle a topic that can sometimes feel a little tricky in tax: income from house property. We're going to break it all down into a super simple, step-by-step guide so you can absolutely ace the calculations.
Okay, first things first. Before we even touch a calculator, we've got to ask three really basic questions to figure out if this tax even applies to a situation.
So think of it like this. It's a three-point checklist. Boom, boom, boom. If you can say yes to all three, it's a building, you're the owner, and you're not using it for your own business, then bingo. Any income you make is taxed under income from house property. All right, let's get to the main event, the real heart of this whole thing, figuring out the annual value. This is the absolute core of the calculation, so let's break it down piece by piece. The first big number we have to hunt down is the gross annual value, or GAV. Think of it like a face-off between what the property could earn, we call that the expected rent, and what it actually did earn. But what in the world is expected rent? Well, it's not just a number you pull out of thin air. It has its own little formula, and honestly, this is the part you really gotta nail down. Okay, so it really all boils down to a simple comparison. Step 1, you figure out something called the expected rent, or ER. Now, how do you do that? Well, you look at two values, the municipal valuation and the fair rent, and you take whichever is higher. But there's a catch. That number can't be more than the standard rent, which is set by law. So that's your ER. Step 2 is easy. What's the actual rent you received? And finally, for steps 3 and 4, you just compare the two. Your GAV is simply the higher of your expected rent and your actual rent. That's it. Okay, let's put this into practice with a real example. House V. First up, we look at the municipal value, $80,000, and the fair rent, $75,000. Which one's higher? Yep, $80,000. But now, we hit that ceiling, the standard rent, which is $78,000. Since $80,000 is over the ceiling, we have to bring it back down, so our expected rent gets locked in at $78,000. And here we are, the final showdown for the GAV. We've got our hard-earned expected rent of $78,000 on one side, and on the other, the actual rent that came in, which was $72,000. The rule is simple: the bigger number wins. And that's your GAV. Getting to the net annual value, or NAV, is super straightforward. You just take that GAV we just calculated and subtract any municipal taxes. But, and this is a big but for exams, two things have to be true. First, the taxes must have actually been paid, not just due. And second, they had to be paid by the owner. If the tenant paid them, sorry, no deduction for you.
Okay, so that's the drill for a rented out property. But what if you live in the house yourself? The rules get a little different. So let's quickly cover these special cases, because they pop up all the time.
The main rule is super simple. For a house you occupy yourself, the annual value is always nil. Zero. Now that means you can't deduct things like municipal taxes. But, and this is a big but, you can still claim a deduction for the interest you've paid on your home loan. And that can be a pretty significant amount, up to 2 lakh rupees in most cases. So let's look at Poorna's situation. She lives in her own house, and she has a home loan. Because her annual value is automatically nil, her entire calculation is just going to be about that interest deduction. Now check this out. Poorna's total interest payment for the year was actually 2,52,000. But remember, the deduction is capped at 2 lakh. So what happens? This creates a loss of 2 lakh rupees under the income from house property head. And the great thing is, she can then use this loss to reduce her taxable income from other sources, like her salary. All right, listen up, because this is a huge one for exams. The law gives you a break. For up to 2 houses that you live in yourself, the annual value is just nil, zero, zilch. You don't even start the calculation. But the moment you add a third self-occupied property, the taxman says nope. They deem it to be rented out, and you have to calculate its GAV just like we did before. All right, now let's get into some of the more complex scenarios. What happens when you live in, say, one part of your house and you rent out the other part? Or what if you're lucky enough to own and use more than 2 houses for yourself? This table lays out the method really well. What you do is you basically pretend Prem's house is 2 completely separate properties. The part he lives in, that gets the nil annual value treatment and its portion of the interest deduction. And the part he rents out, you calculate that just like any other rental property. Then at the end, you just add the 2 results together. For co-owned properties, it's actually pretty straightforward. First, you calculate the income for the entire property, just as if one person owned it. Then you simply split that final income or loss number among the owners based on their share.
Easy. And for rent arrears, old rent you finally get paid, it's taxed in the year you receive it. And the good news is, you get a flat 30% deduction on that amount, no questions asked.
Okay, so once you have your net annual value, you get to lower that number even more. The tax rules give you two really important deductions to slash your taxable income. Let's see what they are.
First up is the easiest deduction in the entire tax code, I swear. It's a flat 30% off your NAV. Doesn't matter if you spent more or less on repairs, painting, whatever. You just get it. It's automatic. No receipts, no fuss.
The second deduction is also a big one. It's for the interest you paid on a home loan. The loan you took to buy, build, or even repair the place. Now, for a rented property, it's pretty simple. You deduct the full interest. But for those self-occupied houses we talked about, yeah, there's some limits you absolutely have to know.
Okay, let's break down these limits. If you took out a loan on or after April 1st, 1999 to actually buy or build your house, the max interest you can claim is 2 lakh rupees. But if that loan was just for repairs or renewals, the limit drops way down to just 30,000 rupees. And remember, for a let-out property, these caps don't apply at all.
Wow, we have covered a lot, haven't we? From the basic rules all the way to these deductions. So let's zoom out and put every single piece together into one final clean process.
This right here, this is your 5-step playbook. Memorize this flow and you'll nail it every time. Step 1, find your GAV. Step 2, subtract municipal taxes to get your NAV. Step 3, slash 30% off for the standard deduction. Step 4, subtract the home loan interest. And step 5, whatever's left at the bottom, that's it. That's your taxable income from house property.
And just like that, you know how to calculate income from house property. So take a second and think about it. What's the one part of this that you think will be the trickiest to remember when the pressure's on in an exam? Is it calculating expected rent or remembering those interest limits? Really focusing on that one piece is going to be your secret weapon.